Online, you will find many people telling you that you should invest, and you might find many of them explaining the benefits of doing so. You might even find that some people are telling you what to invest in and when. However, what you're likely to find less often are those who tell you whether or not you should actually be investing. So in this video, I'm going to explain 3 reasons, or in fact show you 3 points, that will help you determine for yourself whether or not investing is right for you right now. So let's get into it. So the first reason why you shouldn't be investing is if you have any form of debt other than student loans or a mortgage. If you have credit card debt that you have to pay off and that you haven't been paying off, if you have payday loans, or if you have any kind of consumer loan, then you ideally shouldn't be investing. And here's why. With payday loans and credit card debt especially, the interest rate on those debts are extremely high. You're talking 15, 20, 30% or even more. You're not going to get those kind of returns with investments. In fact, returns on investments are not even guaranteed. So if you have loans that you need to pay off that you haven't, then you need to be paying those off first. Let me give you an example. Let's say you've got £1,000 worth of credit card loans that you didn't pay off last month. You might be being charged 20% per year on that bill. Now, if you were to invest in the S&P 500, you will be very lucky to get 20% returns in 1 year. The average historically is around 10%, and even that isn't guaranteed. There are years on end when you can have negative returns. So you're better off paying the credit card debt or the payday loans or whatever consumer debt that you have, because when those bills come due, and they will, you need to have the money to be able to pay it. The risk of loss from not paying off those debts is far greater than the potential gains that you could get by investing in the Nasdaq 100 or S&P 500, in stocks and shares, or even in gold or silver or Bitcoin and so on. So pay off your outstanding loans first. You should not be investing if you haven't even got the basics right. So let's start there. So just by this alone, if you have outstanding debts, you should not be investing. Now on to point number 2. You do not have at least 6 months worth of savings. Now, why is this important? Because, like I mentioned earlier, when it comes to investing, there is no guarantee that what you invest will go up in value. In fact, it is highly likely that at some point you're going to be losing money on that investment. Now, in today's economy, where we know AI automations are taking many jobs and that unemployment is increasing, it is more important than ever to make sure that you have a good amount of savings so that if you lose your job, you do not have to rely on selling your investments to get your money back. One point I want to make is that with investments, you've got to look at it as a very long-term savings account that you will not have access to for potentially a couple of decades. That is the way you have to look at it. And like I said, in this economy, anyone can lose their jobs at any time. So you've got to be prepared for that, and you've got to make sure that, in my opinion, you've got at least 6 months worth of savings. Some people will say it's okay to have less, and that's completely fine. But right now I do believe that it's worth having that much, just because those people who are out of a job can't get jobs. They're out of jobs for several months, sometimes in fact multiple years. And so you need to have savings to ensure that you have some kind of money to use for your day-to-day life. So that is key. Build up your savings. Pay off your debt and build up your savings. If you haven't done these two, then you should not be risking any money on investments that can go up as well as down. Number 3, and this is important, you might need the money that you have invested within the next 5 years. So that could be to pay for a car, to buy a property, to do renovations. It could be anything. But if you need the money that you are putting into investments or you think you will, within the next 5 years, then you should not be investing that money. Like I said earlier, that money that you invest should be seen as a very, very long-term savings account that spans decades, not just a few years. And the reason for that, and I will show you now, is that there is a very, very high likelihood that your money could decrease in value over the next few years. So now I've shown you these 3 points. If you fall into either one of these 3, you should not be investing. That is the most important thing to understand here. Investing is not for everyone. It is for everyone, but you've got to get there first. So it's not for everyone right now. You've got to be in a situation that enables you to invest and to take risks with your money. Because not every investment, in fact, there is no investment that continuously goes up. Now, what I want to show you are some examples of this. And a bonus point I want to add here is that your mindset also needs to be ready for it. So based on these 3 things that I've said, you need to have a very, very long-term mindset with your money. You need to allow time for your money to grow, because it is not always going to grow. It might grow for the next 2 or 3 years, but then there might be a huge financial crash that puts you into a loss for the following 4 years. And you need to be prepared for that. You need to have the mental fortitude to not worry about that money. A bit like with your pension. You can't access it if you're in your 20s. You're not accessing it for at least 35 years or more. And that is the way you need to look at these investments. So you need to be ready for that to happen right now. So let me show you exactly what I mean by you should not need to access the money within 5 years because your investments could fall in that time. Let me give you some real world examples. And I want to start off with the S&P 500. This is the S&P 500 over the last 25 years. Now what can you see here? That yes, over time it does go up. But you can see if I zoom in a bit, hopefully make it a bit easier for you to see, that it doesn't go up in a straight line. It goes up, but there are periods when it comes down. Once again, it's gone up, but there are periods when it has come down. Now, these periods that I'm highlighting, this one was during COVID. It wasn't a very long time. We're talking January to April. However, this period here ran from basically the 1st of January 2022 all the way into October 2022. That's 8 months where the value of your investments would have gone down. Now, of course, since then, we know that the values of those investments would have gone up. We're pretty much we are at all-time highs right now. However, here's what I want to show you. If we go back further in time, what happened here? Well, again, we had a run-up from 1995 into September 2000. However, what happened afterwards was this. From September 2000 all the way through to March 2003, your investments would have gone down. And even then, if you had bought in March 2003, have a look here. Let's say you caught the bottom perfectly. Well, guess what? Back in November 2008 or in March 2009, 6 years later, your investments would have been worth less than you had originally put in all the way back in 2003. Now, this doesn't always happen, of course. I mean, the financial crash hasn't happened again since. But you have to understand that investments don't always go up. In fact, we can go back. So if we draw this, let's draw a box like this that goes across. Now, let's say you had invested here at the very left-hand end of this box back in February 1997. You would have had to wait until basically March 2009, that is 8 years later, before your investments were finally and permanently in the positive. 9 years before your investments were finally actually higher than what you would put in. Now, yes, I know that in this time, your investments would have gone up in value, but then got down again. And what would have happened had, let's say, you lost your job right here in October 2002, and you needed to call on that money you had invested? Well, guess what? You would have got back. You would have taken out what you had invested, potentially made a loss on it after a few years. You would have made more money in a high interest savings account. Or if you were really unlucky and you were made redundant during the great financial crash and you had to call upon your money in 2009, so 8 years later, guess what? You would have lost money on that investment. So this is why I stress the point that you should only invest money that you don't need for at least 5 years, maybe even longer. Now take a look at this, right? If you had invested at any point between 1997, May 1997, all the way through to September 2000, you would have had to wait pretty much 12 years, 13 years for your investments to actually be worth more than what you put in and be permanently worth more than what you put in. So you can see that you should not be looking to sell those investments for a very, very long time. And even more recently, right? Even if we move this bar chart over here. All right, this happened again in January 2015. If you had invested then, you would have had to wait until October 2016. That's not a very long time for your money to have risen in value. This doesn't always happen, of course, after the great financial crash. If you had invested at any point after that, within a couple of years, so from Jan 2010 to pretty much the end of 2011, you would have had to wait just under 2 years for your investment to be worth more than what you would put in permanently. And so we can use almost any time as an example. Again, if you had invested in 2017, in March 2017, what happened? Well, twice actually, in December 2018 and again during COVID, the value of your investments would have been worth less than you had put in. And we can continue finding examples of this. Yes, this doesn't always happen, but take a look. There's almost always a time when you had invested, a year or 2 years later or more, the value of those investments were worth less than what you had put in. And you can see that it's only in more recent years where the stock market has basically gone up like a rocket. But even then, the stock market still comes down. And you have to be prepared for that to happen. So this isn't only with stocks either. Let me now show you with gold. With gold, what I want to do is take you back, in fact, all the way to 1980. Because gold is often seen as a hedge against inflation. So let's take a look, right? Look at this. Gold prices absolutely spiked from 1977 through to 1980, January 1980. And between January 1980 and, oops, wrong one, and what are we looking at? April 2001, almost 21 years. During that time, what happened? Gold prices went down. They went down. 20 years where gold prices went down, and by a significant amount. I mean, from an absolute peak of $870 all the way down to around $250. That is massive. And it's only after this point when gold prices started going parabolic. But even then, take a look. What do you see here? Well, between, what is this? September 2011 down to December 2015, over 4 years, What happened to gold prices? They went down. And even then, for the next 3 years, gold prices really didn't do that much on average. They went up, but only slightly. And again, let's take a look here. Gold prices spiked in August 2020, and you would have had to wait until February 2024 before you finally saw a return on your investment. 4 years. And since then, gold has been going up like an absolute beast. But that's only because of the money printing going on and the geopolitical risks and all of that going on. But my point here is, once again, that you should be prepared that your investments will be losing value for the next few years, and you need to be okay with that. You cannot assume that the value of your investments will continue to go up all the time. It's only in more recent years that this has happened, and there are different reasons for it. Those reasons may change in the coming years. So please keep that in mind. So that brings me back to this and these 3 reasons as to why you should not be investing. If you fall into any one of these, then investing probably isn't right for you. You need to be in a financial situation where you are able to take risks. So get there first and then invest. Thank you for watching. I'll see you on the next one. Leave a thumbs up if you like the video. See you next time.